Business cycles are the shift between strong economic growth, described as a boom or expansion period, and periods of economic decline or stagnation. They are often referred to as cycles of boom and bust. The Swiss historian Jean-Charles Sismondi was the first to identify the occurrence of periodic economic crises, but it was the work of a later economist, the Frenchman Charles Dunoyer, 1786 to 1862, who revealed their cyclical form. Sismondi challenged the market knows best orthodoxy of Adam Smith, Jean-Baptiste Say, and David Ricardo. They believe that if the market is left to its own devices, an economic equilibrium is quickly and easily achieved, leading to full employment. Sismondi thought a sort of equilibrium would eventually be reached, but only after a frightful amount of suffering. Before Sismondi published his New Principles of Political Economy in 1819, economists had either overlooked short-term economic booms and busts or had attributed them to external events, such as war. Sismondi showed that short-term economic movements are due to the natural results of market forces, overproduction and underconsumption, caused by growing inequality during boom times. Fueling the boom. As economies grow and businesses do well, workers are able to demand wage rises and buy more of the goods they produce. This fuels the economy's boom. As more and more goods are sold, companies expand, hiring more workers to produce more goods. The new workers then have money to buy goods, and the boom continues. Competition means that all companies will increase production until supply finally outstrips demand, Sismondi argued. This forces companies to cut prices in order to attract custom, triggering falling profits, falling wages, and layoffs among the workforce. In other words, an economic crash followed by a recession. Companies begin to recover once prices become cheap enough to stimulate demand, and credit becomes more available, starting the cycle all over again. An early crisis that confirmed these economic cycles was the Panic of 1825. This stock market crash was one of the first documented crises caused solely by internal economic events. It was precipitated by speculative investments in Poitiers, a fictional country invented by a conman to attract investments, and the repercussions were felt in markets across the world. Sismondi argued against the laissez-faire approach of Adam Smith, and claimed that government intervention is necessary to regulate the progress of wealth and avoid these periodic crises. The discovery of these cycles enabled economists to analyze the economy in a new way, and to devise strategies for trying to avoid crashes and recessions. Keynes built on Sismondi's and Dunoyer's work to develop his own theories, which were to make up one of the world's dominant economic approaches in the 20th century. In boom times, companies have high profits. They increase production to satisfy demand for goods. This leads to excess supply. Companies cut prices to compete for customers, leading to lower profits, layoffs, and economic depression. Eventually, lower prices lead to an increase in demand, and profits go back up. The economy is a yo-yo. Bull and bear markets. As whole economies grow and contract, markets within them rise and fall. Markets that show sustained price rises are sometimes known as bull markets, those in which prices are falling as bear markets. These labels are usually applied to assets such as shares, bonds, or houses. Bull markets, for example, a rising stock market, often occur during periods of economic growth. Investors become more optimistic about economic prospects and buy shares in companies, so fueling rising asset values. As the economy falters, the process goes into reverse. Investors become bearish and start to sell assets as the market falls. U.S. stocks were in a bull market in the 1990s with the dot-com boom. A major bear market took place during the Great Depression of the 1930s. Trade is beneficial for all. Comparative advantage. The diminution of money in one country and its increase in another do not operate on the price of one commodity only, but on the prices of all. David Ricardo. In context, focus, global economy. Key thinker, David Ricardo, 1772 to 1823. Before 433 BCE, the Athenians imposed trade sanctions on the Megarians in one of the first recorded trade wars. 1549, John Hales, an English politician, expresses the widely held view that free trade is bad for the country. After 1965, U.S. economist Mansur Olson shows that governments respond more to the appeal of a concentrated group than one that is more dispersed. 1967, Swedish economists Bertil Ohlin and Ely Heckscher developed Ricardo's trade theory to examine how a comparative advantage might change over time. The ideas of the renowned 18th century British economist David Ricardo were clearly shaped by the world he inhabited and by his personal life. He lived in London, England at a time when mercantilism was the dominant economic view. This held that international trade should be heavily restricted. As a result, governments introduced policies that aimed to increase exports and to decrease imports, in an attempt to enrich the nation through an inflow of gold. In England, the policy dated back to Elizabethan times. Ricardo thought that in the long run, such protectionist policies were more likely to restrict the ability of the country to increase its wealth. Early trade protection.